Right. Okay, today is Thursday, the 21st, day after FOMC, and markets are actually quite interesting, and our positions are all good. Okay, but that's not a topic. So tonight, tonight because it's 8 p.m. here in Mauritius, this is the 8th session of options mechanics. It's going to be a little bit less technical or theoretical, but if you know me by now, it's going to be a little bit still. And today I want to talk about European versus American options. I've actually done an extensive search on the internet, and a lot of what I've read is really big in the stuff. So we'll go a little bit under the surface, dig a bit deeper, but it's not going to be too difficult today. So as always, the preamble or disclaimer, I'm not using any of the Eromere disclaimer. I mean, it's obviously educational. And as always, it's not exactly a straight path. I felt that it would be interesting to introduce differences between European and American options, and more specifically, whether it makes any sense exercising options. In which case, because often there's no really good motivation for exercising, in which case we can use Black and Scholes, which we have discussed extensively in the first few sessions. So let me go to the first. Yeah, I mean, obviously in the first few sessions, I've talked a lot about Black and Scholes, the limitations, that there's a more generalized Black and Scholes. Sometimes you see in the literature something called GBS, because the newer variants of Black and Scholes allow for dividends. So we've looked at volatility issues, and I've had some feedback about the apparent conundrum arising from that closed equation. I mean, either you know the price or the IV, but you can't know both at the same time. I've tried to provide some answers through volatility surface or modeling the volatility skew or smile. I will get back into that. It's a very complex topic. And incidentally, I'm activating vol surface in my own SOAP program, so I will have things to show. So it's a bit of an aside. It's not really linked to what we've seen previously, but I think it would be interesting. So the question is, can GBS, the generalized Black and Scholes, apply to other types of options? That's a very interesting question. And the fact is that a lot of platforms and market makers and options pricers on the internet stick to Black and Scholes. And whereas there are more sophisticated models, and I could even mention Bjerksen-Stensland. I'm not sure about the pronunciation, but that's the one that is used in TOS. And I have already mentioned Bjerksen-Stensland in the past as being in the same family of options modeling, because it's merely an extension of Black and Scholes, and it does work better for American options. So how many types of options are there in the market? We often hear about vanilla options, and among them, of course, European, American, and there are other types of options like Asian and Bermudan, and more. I mean, Asian. Yeah, well, you know by now that European options cannot be exercised until expiration, and that's the major difference with American options that can be exercised anytime up to expiration and even on expiration day. And it's just I would say, to make things a bit more complicated. Asian will not take um, a fixed settlement or a fixed price at expiration. It will use some kind of an average at expiration to figure out what the exercise price would be. So it is similar or similar to American. I don't know exactly why they exist. They probably actually, from the name, more used in Asia, Hong Kong or China. And Bermudan, just to make things a bit more complicated, Bermudan vanilla options can be exercised only on certain days. So it's like a bit of a constrained version of American. Anyway, and of course there are more exotic options, diary options, and many more. I mean, those I won't get into. Most of us retail traders, we trade either European or American options. And as you know, US indices are European options, and in Europe, all European options are de facto European options. And it is my favorite model because it's simpler. And we will see that being American with any kind of exercising, it's a bit of a, Damocles sword dangling above your head. I mean, those things, you never know when to exercise or when you can be exercised. That's the complication. And so this presentation is to show the dynamics of American options mostly, because we have talked a lot about European options so far. So Black and Scholes and the generalized model caters for dividends. So that one we can use, and as a matter of fact, it can be used in many instances to handle American options. The thing is that American options are priced, of course, there's a risk to be exercised. So the American options are priced slightly differently. And technically, if you use a pricer and you price an option on any American stock, it should be priced higher because of that risk of being exercised. So the American options and the models we will be looking at are similar, but just assume that pricing using a good American options model will provide a price that is higher than Black and Scholes. So we can use Black and Scholes, but it will tend to underestimate the right pricing for an American options. The other reason why we can use Black and Scholes is that very often there's no justification for exercising an option. So one option net explorer only caters for Black and Scholes, and that's good in most cases. TOS uses Bjerkson-Stansland because it is an extension of Black and Scholes, but without rocking the boat too much. So that can be explained. So Black and Scholes, Bjerkson-Stansland, if you use Bjerkson-Stansland instead of, and it's a bit silly that those two guys are also B and S. I mean, they could have come up with another name so that we could have two different acronyms. But anyway, Black and Scholes and Bjerkson-Stansland are in the same family. So we are going to look at possibly a better model. I won't repeat the name again, you can read it. And that being said, it's not perfect because it's actually more complex. And we will see, although that would be touching on a topic I haven't presented yet, that is the Cox-Rubinstein or variations on it. So basically the binomial model or trinomial model, not using a closed form equation, but more a form of finding out the right prices through a number of iterations, and it's in practice, the Cox-Rubinstein, or let's call it binomial, is a better model than Bjerksen-Stensland, but Bjerksen-Stensland is like Black and Scholes, a closed equation. It's easier to compute, so we'll see that, of course, it has some prerequisite hypothesis, and if you go back to what I said about Black and Scholes, the geometric Brownian motion and all those things, the distribution of prices, all those things are important hypotheses that we tend to ignore. And Bjerksen-Stensland also have some constraint or hypothesis we have to be aware of. So what is it about exercising an option? I mean, I'll come back to the very definition of it. So an American option can be exercised anytime before and including the expiration date, so that you can capture profit. So you turn, for example, a call into stocks because you have a right to buy. So you turn your call into the underlying, and the same for a put. If you exercise a put, you are allowed to sell short, if you don't have those options, sell short at a higher price. Of course, I presuppose that saying that it's worth exercising the option, that the selling price would be higher than the current price. Generally, American options would be exercised before an ex-dividend date. So if you have a call and you want to cash in the coming dividend, it would make sense. So there's an element besides the theory and the math or the stats attached to that. There's also a timing thing, or I would say the opportunistic event that can lead to exercising an option that you hold. So that I won't get into because it would be more related to a exercising strategy. And there are a few that you can find on the internet or through experts or mentors who are specialized in that. I'm not going to get into a strategy about exercising. I'm just going to go about some theory or the logic behind exercising an option. So first, and that's what I wrote this slide because again, a lot of stuff on the internet is really basic. And when you read that, and I basically copy pasted it here on the slide, you assume that if the stock is higher than the strike price, it makes sense to exercise a call. Yes. But to me, it's just as valid as looking at any strategy and looking at the expiration shape and say, well, that's where my profit is or my risk is. I mean, effectively, nobody really trades up to expiration. So I would take this with a pinch of salt. It's good to have a picture of what's going on and when it's good to or profitable or interesting to exercise an option. But that being said, it's not as simple. It's not as simple because we're not talking about exercising at expiration. I mean, basically, that's what the European option does. So that's not the point. So it does help clarify what can be done, but effectively, it's never done that way. So if we look a little bit deeper, an option is made of its intrinsic and extrinsic value. So of course, when we look at exercising, we look a lot more at intrinsic value. So the price is, for example, for a call, the current price is way above your strike price. You say, well, there's increased intrinsic value. So it does make sense, of course, to then exercise your option. But at the same time, if you exercise, you turn your option into stock. So you basically give up on extrinsic value. And extrinsic value is where all the Greeks become important. That's where all the stats, the Vega or the IV. So the probability of ending up in the money now gets more important. So the same way as volatility is, of course, a statistical measure, we have to look at the evaluation, statistical evaluation, whether it's worth exercising an option or not. And again, if we're coming back to the previous slide, that's what most people don't really look into. They look at intrinsic, okay, it's good, I can make good money, but you never know exactly what you give up by exercising. And in reality, it's not many people, not many holders of American options exercise early. And I'm not talking about transaction prices, cost, and all those things. The thing is that, and as you can read down in the slide, only 17% of options are actually exercised. And that's also raises the case for Black and Scholes, which is more European style. So even American options are very much, even though pricing is different, because you still have that risk or opportunity, depending on which side you are, of exercising or being exercised. But that is a good case for using Black and Scholes, because very often American options are not exercised. As a matter of fact, maybe more, I mean, not maybe, I mean, it's actually a fact. Deep in the money calls are more often exercised. That can be because the deep in the money calls have a delta that is very high, 80, 90, close to 100. So it would make sense to some extent that you switch from I would say a Greek type of environment where you have extrinsic value to something more stable. But in terms of value, you turn an option that is almost virtually equivalent to holding stock to stock. So in that respect, the extrinsic value is minimal. The intrinsic value is the major part of your option. So in other words, you don't give up that much. And another thing that needs to be highlighted here is, if we look at dividends and you want to cash in the coming dividend, there can be some gut feel that you look, and a lot of, and again, I'm not going to be going into exercising strategies, but a lot of people look at dividend dates in the past and look at what the option and the underlying have behaved when the dividend was detached, and they try and profit from those discrete events at particular dates. The good thing also is that those dates are known well in advance, and so that you can prepare for that strategy. We can, and I'm going to digress a little bit, but of course, if you look at a company, does it have any strong reason to actually provide a dividend? If it's a mature cash cow type of company, Coca-Cola, General Motors, yeah, I mean, they're not growth companies as such, so they don't have that many new projects or new development. So the money they make, they redistribute towards investors or shareholders. So that makes sense. But for a growth company, a tech company, and you can ask yourself whether it makes sense to distribute a dividend, because it could mean that they don't know what to do better with the money. I mean, they've made good profits, but instead of distributing to the shareholders, they probably have some planned for growth, new products. So sometimes a dividend is not seen as something positive, because it could make more sense to keep the money in the company for future growth. So the gain or loss in value is something very, very subjective. That said, if you watch the underlying when the dividend is being paid out, even for a short period of time, there will be a shift, an offset, exact or almost exact, the same dividend amount. So there again, it would be opportunistic, and that's part of strategies, and I'm going to be not going to be touching that in this presentation. The next thing is cost of carry. Cost of carry is something that was initially defined for futures. It's basically, does it make sense? And you will see that, of course, it's the same thinking for options. But does it, I mean, and of course, because there are potentially arbitrage opportunities between cash and futures value. And when you talk about futures, and let's say index futures, the relationship between the cash or the S in this equation, or the current price of the underlying, and the future price is generally the cost of money. I mean, the cost of having the money, or the interest you forfeit by having an option versus cash, or futures versus cash. In addition to that, the discount factor, because that exponential factor is a discount factor. So that is, of course, interest rate. And depending on what type of underlying that is, if it's a commodity, you can have storage costs, and there's something that in the literature is called convenience yield. So all this together make a discount factor of having the cash versus the future. So the cost of carry is an important parameter in the futures market, but by extension, it is important for all types of derivatives, including options. And the reason also why I'm introducing that is that we'll look at some modeling, and again, in particular, Bjerkson-Stansland, where that parameter cost of carry is being used. Now, because I don't have time for a very comprehensive course on cost of carry and futures market and derivatives, and there are very good books on that. But again, if we look at things the simplest way, most of us trade stocks or indices, and options on stocks and indices. And in that instance, cost of carry is basically the dividend yield. With the little caveat that sometimes that element in the discounting factor is made of the interest rate R and the dividend yield, and sometimes cost of carry is just the dividend yield as such and are being looked at separately. I've seen that in a few formulas where cost of carry was named B, and don't ask me why it's named B in that equation, but it is the dividend yield specifically, and not the full factor, including the interest rates. The good thing is that if we look at, again, for example, Bjerkson-Stansland, which is a nice way of looking at it, because it's a closed equation, and you can do all your derivations and gradient calculations. So basically calculate the Greeks. The Greeks are virtually the same. So when you price your options with, again, Bjerkson-Stansland, the prices will take into account the risk of being exercised or the opportunity of exercising. But the Greeks are the same. And here, specifically on futures, there are, of course, no Greek effects. I mean, futures can have some form of a delta effect, because if you short a future, it's equivalent through the multiplier of minus so many delta, and if you long future, you plus so many delta as per the multiplier. So, for example, if you buy an ES future, it's generally equivalent of plus 50 delta on your strategy, and that's something that's beginner to intermediate traders don't do much. They don't mix options with other derivatives like futures. Sometimes they use rather a proxy for the underlying, like a SPY for SPX, where the multiplier is 100. But all those things have no effect on Greeks, except maybe on delta. So when is exercising justified? And boom, I come with something now very complex. The thing is that, and as I mentioned earlier, that deep in the money calls, for example, are sometimes or often the ones which are exercised because it's closer to intrinsic value. It does make more sense. And in the literature, and here I mentioned Stephen Shreve's book on statistic calculus. It's a little bit complicated, but it's still okay, and it's like bachelor's level. There is something that they call an efficient frontier, where it can make sense to exercise or not make sense to exercise. And I wanted to highlight this, just not to fall into that, I call that the beginner's trap, looking at the shape at expiration and looking at intrinsic value and say, well, okay, let's go for it. I'm going to exercise my call. Or it's actually a lot more complex than that because of all the statistics. In other words, what you would be giving up, what you would be forfeiting in terms of extrinsic value when you turn an option into its underlying. And the theory behind it is a little bit complicated, and it's sometimes called in the literature a stopping strategy. Basically, you have a path. The option follows a course of action of value changing according to the several parameters, underlying rates and everything. And that switching strategy or that stopping strategy is equivalent to that kind of curve following what we call a stochastic variable or random variable, or broadly speaking, a statistical variable. I've read a few research papers, and here on this one, the curve is slightly convex, and in some other papers, it is not always. So it can be concave to some extent. So there's no real agreement on this, and because this frontier is the very basis for pricing, exercising, and pricing the option, basically the value of that potential, the mere fact that there's no 100% agreement about this statistical function to actually value the extrinsic value that you forfeit or that you take profit on, that makes things a little bit more difficult. And this time I'm not going to go into those details. Again, I suggest you read Stephen Shreve's or Hull or Hogg, with the three books, which, I mean, John Hull and I can't remember his name, but Hogg, H-A-U-G. Those books are absolute important readings if you want to get into understanding really what's going on behind options pricing. Here I've put a little bit of theory, but basically the profit of nerdy exercises, the underlying minus a strike. I mean, that's the intrinsic value of it. And without going into the detail of the statistics, you start discounting the value of what you would be forfeiting. So that's S minus D minus exponential of. I will provide some detail on the forum if people are interested in this mathematics. But what is important to understand is that it's possible to actually measure, evaluate the value of the extrinsic value that you're giving up. So yeah, maybe I'm repeating myself here, but American options offer more exercise opportunities. They therefore have higher values than European options. That makes very clear sense. Which is also quite obvious is if there's no dividends, the pricing is exactly the same, and that's also a motivation to, I mean, for going back to Black and Scholes. And there's no motivation at all for exercising early. Typically, and also simplifying it a bit, because here I'm not going into the stats, but if the cost of carry expressed as the dividend yield is above the risk-free rate, generally there's no motivation for exercising. So you can calculate using Black and Scholes. And I have posted a spreadsheet with Bjerkson Stensland, and for those who have been brave enough to look into the code, you will see that it's exact copy as per their paper in 1993 and then 2002 when they improved their model. They actually switched back to Black and Scholes if the dividend yield or cost of carry is above the risk-free rate. And at the moment, because we live in a very low interest rate environment, that also speaks for itself. That I would assume that even the 17% historical measure of exercising is probably even less so at the moment, since we've been living for the last so many years in a very low interest rates environment. So that could be the motivation why Option Explorer has never even bothered developing Bjerkson Stensland. TOS uses it, but mainly because it's just an improvement on Black and Scholes, and whether it's the exercising or basically the additional code or the additional modeling is used or not, it's still called Bjerkson Stensland, even though backstage it's basically Black and Scholes being calculated. So if the underlying is way above what is called in the literature I, the trigger price, given by the frontier curve I showed a bit earlier, then you should always exercise the option. So these are those clear-cut examples, and they are actually a lot more clear-cut for, as I mentioned before, deep in the money calls, where you can just, and maybe for those who trade the M3 with a deep in the money call, you can, if you don't want to have that call, I mean, just trade within the underlying it will be about the same. So what pricing model are we going to be using? I mentioned several times Bjerkson Stensland, and now I'm getting used to that funny name. The good thing is that it's a closed form model. It's a simple equation, or simple enough. And the thing is that it's quite easy to calculate Greeks. And again, in most cases, the Greeks are exactly the same as with Black and Scholes. That being said, the binomial or trinomial, binomial is often called also Cox-Robinson. The thing is that because they use a lot of iterations to get to converge towards the right price, they are very, very slow. So they're not very efficient in terms of computing, but they do provide better results. And there have been a number of experimentations that you can see in the literature. So I would say that in many cases, if you just want to price one option now and then, and if you have binomial at your disposal, use it. It will give you a better pricing. So you will have a better idea whether it really makes sense to exercise or not. But for convenience, Bjerksen-Stensland is easier to use. One thing is that, of course, like every model, that's what I said earlier, Bjerksen-Stensland assumes a flat frontier. So we don't care whether the efficient frontier that we've seen before is concave or convex, or they consider it as being flat across the board. So they can lead to pricing errors. The common sense would say that yes, there's a rationale for exercising deep in the money calls because of the amount of intrinsic value, but what's going on here? Bjerksen-Stensland may price it poorly. So that's something that to keep in mind, that no model is perfect. But if you trade mostly near the money, it should be okay. It should be okay. Bjerksen-Stensland also is quite sensitive to some statistical calculations. If you read the paper from those guys, they provide 4 different types of statistical cumulative normal distributions. None of them are great, basically. There have been some improvements, but it's quite a stable model. I haven't seen a lot of improvements since the paper in 2002. And there again, as I mentioned before, in most cases, a lot of the code is bypassed and it reverts back to Blackhead-Scholes. Something that we need to keep in mind is that when you trade American options, you can't take advantage of a few relationships that I've mentioned before in previous sessions, because there's no put-call parity for American options. The Greeks will be equivalent or similar, and I know that some quants or academics would be furious about me saying that, but as a practitioner, I would say in terms of Greeks, it's about the same. But you can't really expect, for example, like Can you hear me now? Oh, bummer. So I don't know exactly where it stopped. Can you point me to where was I before it stopped? You know what? Um, I am going to slide 15, pricing model. Okay, okay. You know what? I think I'm going to come back to that next time. I think you've got a lot to absorb already. So I will do a bit of a recap on the next session before I move on to volatility stuff, or maybe other relationships, Greeks or the like. Sorry about that. I didn't notice that the mic went off. I just see now that there was a notification, but it didn't pop up right in my face as it should have. Anyway, sorry about that. Thanks for being there anyway. If you have any questions, there's a forum for it, or you know where to contact me, bruno@ariomir.com. I know it's a bit complex. I hope I didn't make it too complicated. But anyway, there was only 18 or 17 sessions, so you only missed 2. So I will do a recap next time. Thanks for being there, and I'll see you around next time. Bye for now.